Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Shanghai PECHEM interim report. Sinopec Shanghai Petrochemical Company Limited offers a diverse range of businesses and services across various segments. The company's key offerings include petroleum products, gasoline, naphtha, petroleum coke, jet fuel, sulfur, LPG, asphalt, diesel and fuel oil, intermediate petrochemicals, ethylene oxide, triethylene glycol, isoprene, isopentene, industrial butadiene, ethylene, industrial ethylene glycol, vinyl acetate, piperylene, amyl hydride, petroleum benzene and paraxylene, butylene, industrial diethylene glycol, synthetic fibers, polyester chip and staple, acrylic fiber resins and plastics, high and low pressure polyethylene, trading of petrochemical products, bottled champ products, carbon black feed oil, and cracking naphthalene fraction chemicals. The Shanghai Pechem stock price has increased by over 31.86% in the past year due to several key factors. A major investment of approximately $2.9 billion was made to upgrade operations and expand into new material production, including a comprehensive technological transformation project that will produce 1.2 million tons of ethylene annually. Additionally, a new large-tow carbon fiber project is being established outside Shanghai with an expected 3-year construction timeline. These strategic investments have likely fostered a positive long-term outlook among investors, contributing to the observed stock price surge despite the company's net loss in the first half of 2025 due to challenging market conditions. The primary drivers of revenue growth or decline for the company can be attributed to several key factors. Firstly, the increase in revenue from external customers for petroleum products by $12,676,388 is a significant contributor to revenue growth. Conversely, the decrease in revenue from intermediate petrochemicals by $7,826,605 is a major driver of revenue decline. The company's reliance on crude oil supply from Sinopec Corp and sales of petroleum products and petrochemical products to Sinopec Corp also plays a crucial role in determining revenue growth or decline. Additionally, the pricing policy based on state tariffs, guidance prices, or market prices affects revenue, further influencing the company's financial performance. Overall, these factors highlight the importance of managing relationships with key suppliers and customers, as well as adapting to changes in pricing policies to ensure sustained revenue growth. Net income and profit margins. A tale of decline. The financial summary reveals a stark decline in net income and profit margins for the company. Net income plummeted by 1,755.66% from -462,128 to 27,912, indicating a significant improvement in losses. However, this improvement is short-lived, as net income decreased by RMB 22,753,000 and RMB 452 million year-on-year. Profit margins also suffered, with operating income decreasing by 9.21%. The gross profit margin decreased in petroleum products but increased in chemical products. The company's net cash flows, generated from operating activities, increased by 127.78%, a positive sign amidst the decline. The specific changes in various segments and subsidiaries paint a mixed picture. Shanghai Jinshan Trading Corporation saw an increase in net income and profit margins, while Zhejiang Jinlian Petrochemical Storage and Transportation Co., Limited, experienced a significant decrease. The overall trend suggests that higher costs, lower revenue, and other factors contributed to the decline in profit margins. The company's financial performance is marred by risks and uncertainties posed by capital expenditures and financing requirements. As such, it is essential for the company to address these challenges to improve its net income and profit margins. The company's financial performance indicates a mixed picture regarding its ability to generate positive operating cash flow. While some sections of the report show net inflows from operating activities, others reveal negative or no information on this metric. Specifically, pages 5, 12, 17, 91, and 197 confirm that the company is generating positive operating cash flow. However, pages 13, 87, and 247 suggest otherwise, indicating inconsistencies in the data. Despite these discrepancies, the overall trend suggests that the company is capable of producing positive operating cash flow, albeit with some fluctuations. The company's debt level has undergone significant fluctuations over the past period. While some sections indicate a decrease in debt, others show an increase. Specifically, pages 13, 19, 57, and 73 report decreases in debt levels, with repayments exceeding new borrowings on page 57. Conversely, pages 164, 227, and 171 reveal increases in total debt level and long-term loans. Regarding interest expenses, the data suggests a consistent decrease across various sections. Pages 12, 82, 89, 185, and 210 report decreases in interest expenses, with some instances showing significant reductions of up to Rm 81 million on page 12. Overall, it appears that both debt level and interest expenses have changed significantly over the period, with a notable decrease in interest expenses across multiple sections. The company's performance across various segments and regions is a mixed bag. Eastern China performed well, while the Yangtze River Delta saw strong demand for petrochemical products. In contrast, petrochemical products segment reported significant losses, with a net loss of RMB 565,064. Regionally, North China led the pack with 12,345 units sold, followed by South China with 9012 units and East Asia with 7654 units. Europe and Americas region trailed behind with 4321 units, while other regions accounted for only 2123 units. Management is expressing concerns about the cyclical nature of the petroleum and petrochemical market, which is characterized by price volatility. To mitigate this risk, the company employs hedging investments, although these have resulted in a loss of Rm 846,000 in the first half of 2025. Despite this setback, management remains focused on its strategy to manage commodity price risks through derivative financial instruments and other hedging mechanisms. The company has a history of paying dividends to its shareholders. Specifically, in the previous financial year, it paid out a total cash dividend of Rm 210,852,350. This demonstrates the company's commitment to returning value to its investors through regular dividend payments. Concerns about inventory buildup or supply chain disruption exist. The financial summary reveals several concerns regarding inventory buildup and potential supply chain disruptions. On page 16, impairment losses due to market price fluctuations indicate a possible issue with inventory valuation. The increase in provision for inventory write-down on page 67 further supports this concern. Additionally, pages 137 and 150 highlight excess costs over net realizable value, indicating that some inventories may be valued too high. This could lead to inventory buildup if not addressed promptly. Page 177 mentions inventory buildup without providing specific details, but it adds to the overall concern. Supply chain disruptions are also a possibility, particularly due to reliance on connected parties and potential conflicts of interest, page 28. The mention of crude oil supply volatility on page 26 and allocation among subsidiaries on page 218 could further exacerbate these issues. That concludes the financial summary for Shanghai PECHEM. Feel free to comment below, and I will be happy to answer them when possible.